Robert Weinberg here, your mortgage advisor and financial coach. I want to discuss some different mortgage acceleration strategies that you can use to pay off your home loan quicker. So the first strategy we can talk about is biweekly payments. So in essence, what biweekly payments does is it has you make your mortgage payment bi-weekly instead of monthly, which ends up being 13 payments per year instead of 12 payments per year. So one extra payment per year. What does this do? Well, on a 30-year fixed mortgage at 4%, it could actually accelerate your mortgage payoff by 5 years to where you'd have a 30-year loan paid off in only 25 years, and that would save you tens of thousands of dollars in interest. So it is definitely an attractive feature. There's a few different ways to implement biweekly payments. The first one is your mortgage servicer may have a free program that allows you to just enroll in biweekly payments, and they'll take a mortgage payment from you automatically every 2 weeks, so you'll be able to accomplish that biweekly accelerated schedule. Be aware that some mortgage companies and servicers do actually charge an extra fee for this. If yours charges an extra fee, I do not recommend it, and I would caution against it, because the fees, while they may not be high, they can definitely compound over the course of several years, and you can actually accomplish a biweekly payment strategy on your own. The way that you do that is by taking your total mortgage payment and dividing it by 12 months, and then that amount you would add to your monthly mortgage payment to accomplish that extra payment per year. So for example, if your mortgage payment is $1,000 a month and you divide that by 12, it's $83.33 extra per month that you would add. So instead of making a mortgage payment of $1,000, you would make it $1,083.33. That would in essence accomplish the exact same thing as a biweekly payment strategy, and you could do it on your own without paying any fees. The next up I want to discuss is the debt snowball and the debt avalanche. Now these are more advanced debt elimination strategies a lot of people use for paying off credit card debt, auto loans, medical bills, etc. But you can actually use the same strategy for your mortgage. So the way that it works is you take your debts in order of smallest to largest on the debt snowball, and the debt avalanche, you go from highest interest rate to lowest interest rate, and then you would start applying extra money to those debts until you get down to the highest one on the totem pole, which is typically a mortgage. And then you could take the money that you were spending on the credit card debt and other debts and apply that to your mortgage. So that could end up being an extra $500,000 or more per month. That is a great strategy if you have other debt that you're trying to pay off and ultimately want to pay off your mortgage. This would accomplish both of those. And I do discuss this in detail more in some other videos, as well as chapter 4 of my book. The next strategy we can discuss on paying off your mortgage early is using financial software, financial technology, fintech, to pay your mortgage off early. So in essence, the way this works is you put your monthly budget in there of your income and expenses. The software uses clever use of timing to instruct you when you have extra money in your account that can be used to pay your mortgage down. And I've seen these software programs that can range from a few $100s on the low end up to $3,000 or $4,000 on the high end, and they do a great job. However, they can be quite costly to have a computer software analyze your budget constantly and make decisions on when you should prepay your mortgage. Please be aware that in order for this strategy to work, you do have to follow it to a T. So it's very important, if the software tells you to make a $500 prepayment on your mortgage, you do want to follow that instruction in order to maximize the use of the software. And another strategy a lot of people use is just to simply refinance to a shorter term. So if you're on a 30-year mortgage, maybe you have 28 or 29 years left, your cash flow is good, you don't have a lot of other debt, it might make sense to refinance down to a 20-year or a 15-year mortgage, even a 10-year mortgage. So for a lot of clients, we can combine the shortening of the term with a debt consolidation loan or another strategy that will allow you to actually prepay your mortgage using money that was going towards other debt or other places. So it ends up not being such a big burden on your monthly budget. And last but not least, the most advanced mortgage acceleration strategy that we can discuss here is a first position HELOC. Now again, this is not for the faint at heart. It's definitely the most advanced, but also the most effective mortgage acceleration strategy. So what this involves is refinancing your mortgage into a home equity line of credit, a first position home equity line of credit. You're going to put all of your income into that home equity line of credit and pay all of your bills out of the home equity line of credit. So much like the software in the fintech strategy, this does cleverly use timing in order to lower the amount of interest that you pay. There's a lot more in-depth information on this strategy if you're interested in it. And I do talk about these and other mortgage acceleration strategies in my book, Mortgage Strategies for the New Millennium, which is available on Amazon. Hopefully this has been of help. And as always, if I can be of assistance, feel free to reach out via social media or call or text my office at 860-413-3938. Talk to you soon.